even if it went up fourfold, which would put it, $200 silver above the $50 high. That would be normal, but most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long or way too low for too long. When they compensate for the mistake, they often do two things. One, they compensate with speed, that sometimes is shocking, and two, an overshoot of reality. Okay. And of course, if silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at fourfold. They'll probably be at sixfold, sevenfold versus 1980. So silver's not going to go to 200 fourfold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me, don't chuckle, if you had $1,000 mark on silver at some point in the next year.
Precious metals markets are setting up for an explosive repricing phase as underlying momentum shifts decisively in favor of hard assets. While conventional traders focus on short-term sideways pullbacks, long-term technical structures confirm the overarching secular bull trend remains completely unbroken. Michaeloliver, a veteran momentum structural analyst, observes that intermediate momentum indicators have flashed an aggressive upside pivot following months of base building. When protracted market distortions finally correct, they typically resolve with breathtaking velocity and violent upside overshoots. A standard normalization projects silver surging past $200 to establish a new pricing floor, representing an expected fourfold expansion above prior record highs. However, this cyclical advance is projected to run substantially higher, with technical momentum models indicating silver could realistically challenge the shocking $1,000 mark within the next year, as paper market imbalances collapse under physical demand pressures. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I'm going to lift my target, and I don't mean lower it. I mean probably lift it, and I'm not going to put a number on it. I'm just going to say that I think silver will go berserk. And the reasons are, there's multiple reasons. We can get into those. But yes, and the action last week turned up our intermediate trend metrics, momentum things. Now, what I mean by that is when you look at long-term analysis of silver and gold bull trends, like annual momentum, so forth, the break was a nice break, but it didn't break anything. It didn't break any structures on momentum. So the long-term trend remains positive. That was a negative zigzag in a positive trend. So, but when we go down to more intermediate technical factors, things that come and go in a matter of a couple months or several months, they turn negative. They turned negative about in March, really, prior to that war break. Okay. But since then, if you stand back and look at a silver or gold chart, go back to that break that occurred in late January, early February. It was really about a 2-day break. People don't realize it was like 2 days. Bam. Silver hit a low of 63.90. Whew. And then went back up to like $90, and it came down and made another low at about 61. Didn't fall apart and turned back up again. Teasing rally. Then came back down again, got to about 56. Okay. But right now we're trading 65. Okay. We're back above those lows, all the lows that occurred, the sequence of lows. But if you think about it, all those lows were like marginal teasers. The real low occurred 2 days after the high in February. And so since then, you could draw a line sideways on silver and say, well, yeah, it's still under pressure, but it really isn't going down much since 6 months ago. Okay. So somebody's been buying that beast down there. Okay. Same with gold, same sort of pattern of a low in early February, then another low in March, and then you get the point. The upturn we just had last week on most people's charts say, well, it's just another rally in this nonsense range. It's no good. It's just a sell the rally. But when you look at momentum, it says, no, this one's different. This is a rally that will likely sustain and work its way back to and through the highs. And I don't think it's going to take a long time. I think it may take like a month. Suddenly you're back up well off the lows and challenging the high. But forget that. The issue is, where are we going? And a lot of people make the mistake of taking out their old daily price charts or weekly charts from 1980 or that second high we made at $50 in silver in 2011. And they say, well, we just collapsed just like that 1980 peak, and it took them decades to get back up again. Okay. Well, that's assuming, don't look at the old arithmetic charts. Look at a ratio scale chart, percent scale. We've run these charts before, but think about this just for a moment. You don't have to be a technician. Metals. Let's see what metals here. These are just examples. Lead, steel, zinc, aluminum, copper, all base metals, and gold. Where are they trading right now versus where they made their highs back in 1980? About 4 times that price level. Okay, 4 times. Gold's more than 4 times where its bear low was in 2015 or where it was in 1980 when it made a peak at 850. Multiply that times 4 and you're above that level. Silver's what? Trading 10, 15 cents above its 1980 high. So let's say silver made a mistake. Supply-demand mistake. We know we have a deficit. It's been for 6 years or so where we're not producing enough silver to match the demand. And yet that's ignored. The fact that most metals on the planet are 4 times where they were in 1980. And yet silver is overdone, with a pullback recently to a 6 cents above its 1980 high. I mean, give me a break. Okay, so what caused that? Well, I don't have the answer. Some people I respect do, and they argue it's been actually manipulated by major banks, perhaps working in shoulder to shoulder with the central bank. I don't know. Forget that issue. But obviously, silver, for some reason, has not moved in reality with every metal on the planet. And its mama metal in the monetary sector, gold. It moves with gold, right? Okay. Well, how come when silver back in 1980, for example, was what? 6.5% of the price of gold. Divide an ounce of silver and an ounce of gold. Where's silver right now? About 1.5%. What's going on here? We don't need silver anymore? It's not money anymore? No. Silver made a mistake. And therefore, to get back to the first issue about where we're going, even if it went up fourfold, which would put it, $200 silver above the $50 high, that would be normal. But most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long or way too low for too long. When they compensate for the mistake, they often do 2 things. 1, they compensate with speed, that sometimes is shocking, and 2, an overshoot of reality. Okay, and of course, if silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at fourfold. They'll probably be at 6-fold, 7-fold versus 1980. So silver's not going to go to 200 fourfold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me, don't chuckle, if you had $1,000 mark on silver at some point in the next year. Okay, because there's a lot of things going on out there. We can get into that.
A severe structural deficit has gripped the physical silver market for over 6 consecutive years, yet institutional paper mechanisms have consistently disregarded this tightening supply. Across the broader commodities complex, industrial base metals like copper, aluminum, zinc, and lead are already trading at 4 to 6 times their historical 1980 peak valuations. Gold has similarly maintained parity with broad monetary inflation, leaving silver as the single most anomalous asset on the planet. This deep divergence represents an unprecedented pricing error rather than a loss of monetary relevance. Physical consumption across global industries continues to outpace mining output, while sovereign buyers quietly accumulate physical reserves. As this tightly wound congestion pattern finally breaks, the market is poised to rectify decades of artificial suppression through an explosive repricing event. Now, let's get back to the interview.
I think it's somebody looking for an excuse to why silver didn't go up like gold. Okay. So they say, whoa, China is buying gold, not silver. Okay. Well, I think India is actually heavily involved in silver right now and even moving toward monetizing it maybe. But for 3,000 years, silver's been money. Poor man's gold. Okay. With official government stamps on it even. Okay. So no, I don't think suddenly now because somebody wants to explain why silver didn't match gold, it's not money anymore. We suddenly decided. Well, we'll see. Okay, I don't accept that argument. I think what's going to happen is silver's just simply made an error. A lot of markets do, and whether that was in part manipulation, But it's when it unleashes, it goes to a new reality. It likely will overshoot that reality even. But I'm looking at various metrics, not merely that if all these metals are 4 times their price in 1980. Well, they're not stopping either. Copper's continued 6 times where it was in 1980 right now. Okay, 1980 was $1. The point is that silver, if it's compensating for that major error, pricing error, relative to anything, relative to all these basket of base metals, gold, etc., it likely will do it with speed. And I suspect that when that event occurs, and I think it's coming, I think when we come up out of this congestion, and already we have signals that we're coming up out of here. Okay, you can wait till the new high if you want to. But on the other side of this congestion zone will be something that will drop jaws, and be so rapid, so quick that people just won't understand it. But at that point in time, I'm going to bet that certain other fundamental factors come into play that already are in play, but have been long ignored by investors and analysts and talking heads on financial TV, mainly monetary crisis, debt crisis, government debt crisis. We haven't had one of those in a long, long time. Okay. In 2008, the markets collapsed. Silver and gold went up 2000 through 2011, but the stock market went down because of what? A debt crisis, but it was just mortgages. This time it's government bonds. This is a nuclear event. And it's only now marginally becoming sort of a sideline issue on financial press. It's so major, it should be the front headline. It should have been for a year now. The Japanese went into the hole, and now suddenly we're going into the hole with them. In fact, we're helping fund them try to get out of the hole. We're printing money to support the yen, so they'll continue to hold bonds, like a circle there. Okay, it's a game, but it involves what? Printing money. That's what moves monetary metals. That's one way to approach it. You could basically just sort of throw a dart at the sector and say, I don't know which ones are going to do better. Now, we do, in fact, every month sift through the miners to try to find the outperformers, the ones that are beating the sector ETF. But you could probably just throw a dart at it and buy an ETF like GDX, which is only 20% silver miners, or SIL, SIL, Global X Silver Miners ETF, which is focused on silver miners. And you will vastly beat gold. Now, I don't know they're going to beat silver, but gold, while it's the mama monetary metal and it's going up big, these guys are going to go up a lot more. Now, it's an issue about where's gold going, the mama. Okay. I've said this before, but you go back to the history of gold since it was, quote, legalized in the U.S. There was a bear low in 76 that went up to a high in 1980, and it was an 8-fold move. Price of the bear low to the bull high, 8 times. Okay. Different duration bull market, but from 2001 to 2011, gold had another 8-fold move from a bear low to a bull high. Where's gold right now? Well, the bear low was 1,050 in 2015. We're 4-fold. So if gold even just said, I'm going to do it again, have yet another 8-fold dimension move, then you're talking $8,000 to $9,000 gold just to match the dimensionality of those 2 prior moves. What if gold goes further, which I think it likely will, because I think we're facing something we've never faced before. Gold's gone up due to a monetary expansion, inflation, et cetera, et cetera. Inflation is defined by money growth, okay? This time we have a monster, a nuclear event with the government debt market, because when they have to print to keep that house from burning down, it'll go off the page. And people will then say, well, goodness gracious, I thought, it was 60% stocks, 40% bonds, was a balanced portfolio. Oh, that's right. The CIO of Morgan Stanley about 6 months ago said, no, it's 60% 20/20 bonds, gold. He brought gold into the equation. I don't agree with his percentages, but his recognition of the reality was very bold. Gold must be in your portfolio. But what if bonds don't work? What if the stock market's topping, as we argue it is, and it won't take much to really get it going on the downside, like, a 10% drop will cinch that it's topped. I think that will occur. That will further motivate the Fed into printing. But then when you say, well, I'm going to go to the alternative that usually is a safe place to be, it isn't T-bonds. They're horrible looking. Look at the price chart. Look at the yield charts. And they've just begun. We're entering what probably is going to be a bond market panic. And of course, we know what the Fed's going to do during that time. There'll be no limit to what they do. And that leaves you with what alternative? Money, gold.
Global financial markets are hurtling toward a systemic sovereign debt crisis that threatens to overturn conventional asset allocation models. Unlike the 2008 subprime mortgage collapse, the current instability is rooted directly in the government bond market, representing a profound structural fault line across worldwide financial architecture. At the same time, equity markets are exhibiting distinct distribution topping patterns, where a straightforward 10% decline will decisively initiate a prolonged bear trend. When sovereign debt markets face acute stress, central banking authorities are inevitably forced into aggressive currency expansion and emergency liquidity injections to keep bond yields from spiraling. This relentless monetary debasement destroys the purchasing power of fixed-income instruments and invalidates traditional 60-40 investment portfolios. In an era defined by fiscal deficits and systematic money printing, capital must inevitably migrate toward tangible wealth preservation. Mining shares and specialized equity vehicles like the SIL Silver Miners Fund and the Broad GDX Sector Fund provide vital operational leverage as balance sheets adjust to systemic currency dilution. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.